Alright guys, I'm back with another video today. This one would be uh, a very high level, high time frame overview of how things have been panning out for the last couple of years. And I want to show you guys some interesting things that you should think about. So as if you can see, this is the weekly chart for Nasdaq, and I have some um, vertical lines here that depict uh, important moments in time when uh, things happened in our um, environment, financially, politically, economy, different things that caused uh, some sort of a decline, either a correction or a crash in the markets. Um, so the most recent one we have are the tariff wars of 2025, which um, are sort of the catalyst that has caused a sudden decline in the market. Previously, we have seen the decline of the 2022 uh, uh, year. This was due to the um concerns about high inflation and need to cut down the interest rates. And even before that, we had the COVID-19 pandemic, which caused a sudden crash and then a very quick V-shaped recovery out of it due to the stimulus packages. And even before that, we had the 2018 Fed Powell rate hikes to uh, curb the inflation. So I'm going to show you guys um, using the standard deviations today of uh, exact areas where the market started to decline. Um, some would say it's a coincidence, but and that these events were just used as a catalyst to then bring the market back down to mean reversion to then bring it back up. So if you look at it, uh, ever since COVID happened, uh, so we had our stimulus packages that were uh, given out to the population that has caused the market to keep rising. And if we use the Fibonacci to draw the standard deviations, you can see that usually what happens in the market is ideally 2 and 2.5 standard deviations are good places to take profits, but if the market tends to keep going higher, the 4, 4.5 and 5 are extreme extensions where the market definitely needs to uh, revert from to back to a mean reversion or average uh, zone from where people can then start buying again um, and then the price can start reverting. So as you can see, uh, I wouldn't say this was a coincidence because we had the COVID-19 sell-off, and then we had a V-shaped recovery out of that area, and then I wouldn't say it's a coincidence that in 2022 we had a correction that came about. The Fed started to recognize that the inflation was very high in the economy, and they had to cut down interest rates to bring uh, the market back down to 50% of this range. And that's what you see is the 50% of 4 and 4.5 standard deviations is 2.5 standard deviation. And that's exactly where you see the market reach back to. And then it took back off. So moving forward, so we can see that there has been a correction after the COVID-19 uh, price uh, rising, and then sort of a return to 50% of this range here. You can see it's there from ever since the COVID-19 sell-off to 2022. The 50% of this range is right here around 11,500-ish area. And that's where you see the price returned back to the mid-range, and then it took off again. So we can sort of use that same um, strategy to find the 50% of this range. And I'm going to show you guys here using these levels. So the 50% of this range is around 16,500. So that is a level to look out for. Currently, like I said, we have the tariff wars going on. President Trump has introduced global tariffs to be implemented, which is being used as a catalyst to bring the price back down to a mean of this range. And we can definitely use, I would definitely mark this area as the mean of this range here, from where we might see some sort of uh, recovery out of. So note this area. And the other thing I do want to mention is those of you who use ICT's um, ICT's strategies, you can see these gaps around the 75%, 50%, and the 25% of this range. And these gaps are very, very important. As you can see, this gap right here at the 50% aligns with the 50% of this range here. I wouldn't say that that's a coincidence. So we can definitely see uh, price coming down even further down to this level. And even in extreme cases, we might even see it drop down to this zone down here from the 13 to the 1500s as well, before it then recovers. But for that, we would have to keep an eye out of for the Fed Powell's decisions regarding rate cuts, uh, holding some sort of an emergency meeting to then provide some sort of recovery for the market. If he chooses not to um, act on this sell-off here and continues to hold and evaluate the situation, then we can most definitely see a price falling below the 50% and even come and test this gap here around the 75%. Or if you do the opposite, uh, it's the 25 percent of this range here. So these are very important levels to keep an eye out for. Um, if I take this level off, and then if I use this swing point here to draw a Fibonacci level, you can see that price went up to the extreme range of 4.5 to 5 standard deviations. And that's exactly when uh, President Trump um, announced the tariffs to be implemented, and that's where you see a sudden decline in the price. So, like I said, the mean of this range is 2.5, this area here, even down to the 1.5. Like I said, it can come down below this 50% of this range and test um, this gap here. So if we look at everything technically using standard deviations, these are the levels that you should look out for. And yeah, I guess this is something controversial, but these events that happen throughout our history are used as catalysts to sort of bring some sort of fast corrections in the markets. Like I said, currently we are going through the tariff wars of 2025. Previously, we've had the rate hikes. Before that, we had the COVID-19 sell-off that had caused this. So the other thing, you when you look at um, this recovery, you can see that um, if we take this range, measure this range, you can see that when COVID-19 happened, the sell-off didn't stop here at the 50%, or it did have a strong reaction. The weekly candle for March 9th closed at the 50%, but it didn't but then it continued to drop until the 25% of this range. And like I said, it's this is like the extreme correction, and that's when we see a V-shaped recovery out of the COVID-19 sell-off due to the stimulus packages that were introduced. So those stimulus packages were used as a catalyst to then provide recovery. Um, so throughout history, you can go back and you can find some situation where um, this has happened in the past. Um, this is the other example. Um, this range right here, we return to 50%, have some sort of accumulation in that area, and then we continue to drop more. So the 25 uh, and 75% of the given range, the previous range, are important areas to keep in mind. So usually, yes, ideally 50% is the mean range where price should return to before it then recovers from and continues to go higher. So using the standard deviation tools are very, very important technically, um, to plan your trades. So yeah, uh, I wanted to share this with you guys as well. So using the same sort of principles, using standard deviation, we can formulate a, a plan for trading this for this correction. Uh, this is not financial advice. This is something that I just wanted to share with you guys, and something that I will be doing. So again, these are just ideas. You may or may not use these to implement your trading in your trading. But so after this correction here, we saw price increasing again, and now, as mentioned, we are currently going through the 2025 tariff wars, which has been used as a catalyst to bring the correction in the market. So if we use the standard deviations to create these levels, you can see that this is the 50%, and then below that we have the 25 or the 75%, depending on how you draw the tool. But these two are levels that I am looking out for. Currently, our Fed Powell has said this past week, we are currently in the first or second week of April. He has said that he will wait, and he has not decided on any rate cuts just yet. He will wait and see what happens in the market and how the everything pans out with the tariffs. So that we can use that news to then expect that the market would continue to sell off, either below the 50%, to reach the extreme downside from 13,500, or between these zones from 13,500 to 15,000. So, but above that we have the 50%, which is around 16,500 ish level. We can most definitely see some sort of a reaction around the 15% or 50, sorry, percent of this range, which is the mean of this range. So usually there's some sort of a reaction, but if it doesn't hold here, we will most definitely see a further sell-off down to the 13.5 level. So standard deviations are most definitely important to use when you are formulating your trading plan. Um, but yeah, so um, this was a very high level review of what has been going on historically, how we have used things in our economy, or uh, how we have used inflation or news events to then bring corrections or crashes, uh, or to the price. Uh, so currently it's the 2025 tariff wars. Previously it was the rate cuts due to inflation. Before that we had COVID-19 happen. Um, Even before that, and then before that, we also had further rate cuts due to uh, inflation of some sort. So these are cycles that happen every now and then, from time and time again. We will see this happen, continue to happen, and you can use these to formulate your trading plans. Again, this is a reflective report, and I will be back with another video next week. Take care, guys.